So please welcome the President of the Party of European Socialists, the former Prime Minister of Denmark, Poul Nyrup Rasmussen.
Thank you.
Thank you so much, Poul. Lovely to meet you. Thank you.
Yeah, good morning to everyone. And thanks to my friend from Iceland. Good to be here with you. I think we could use a bit more solidarity with you from European side. Just that you know, the fact that you haven't got that assistance is not the same as saying that we don't follow you and that we're not engaged in ensuring that all these innocent people in Iceland who have nothing to do with speculation and excessive debt trading, we need, of course, to relate to them in exactly the same way as we do to Latvia or Lithuania or Ireland or Greece or whatever. So good to see you here, and thanks for the infos. Can I just start where we are just right now in recognizing that we have a financial crisis? You know how politics is, that when someone begins to make a hype situation, then the financial market is saying, as it has been saying all the time, well, now we are on our way out of the crisis, so what are you talking about? Why should we regulate now? Nothing is more worthwhile than using all our efforts to invest now in new jobs so that we can get out of the crisis. I see that as a part of the problem, because if we don't recognize now, finding ourselves still in the world's strongest recession we have ever been in since the Second World War, if we cannot now have a decision process, an analysis, and a conclusion which is reasonably close to reality, then I'm very pessimistic on behalf of economics and financial markets. You should know that the latest prognosis for the European Union is that we are now having an unemployment percentage in the European Union on around 9.5–10%, corresponding to 22 million unemployed people. And if we look at the consensus prognosis, which you also know, we can say that yes, there's a hype-based upward trend on the stock market, but we also know that the sluggish growth is the most likely tendency on the real economy we're going to have in the next 5 years, which means that the sluggish growth will, for the European Union, be around something between 0.5% and 1.5%. And if you have a productivity of more or less the same size, you can easily understand that unemployment is not going down, even if you take into your account also the demographic trends. Unemployment will raise. And it will raise next year to 30 million unemployed, close to 11% in the European Union. So don't blame the US too early, dear friends. We will soon catch up as far as their unemployment level is concerned, unfortunately. I'll come back to what we can do about it, but I would like just to place this discussion we are going to have today into that framework, because if we look at the financial market as it is right now, and we say, well, did the bailouts then bring us a bit further on as far as investing and financing new investments, especially if we look at the small and medium-sized firms? Now, if we ask the small and medium-sized firms right now, they tell us that they are in a worse situation as far as getting their investments financed. Access to finance is a major problem for the small and medium-sized. In fact, 20% of SMEs need more bank loans now than they did 6 months ago. The vast majority of small and medium-sized firms do not expect their capacity to obtain external funding from banks to ameliorate in the near future. So my point, overall bank lending to companies have diminished by 100 billion euros since the beginning of year 2009. This investment gap is bigger than the money that had been injected by the 6 largest EU member states in recovery plan in 2009. That's why I'm saying that we have a double-digit problem now. Number one is to get the banks functioning on the short lane, to get them financing small and medium-sized firms' investments, and on the other hand, insisting with a foot in the door that we must start on a coherent new financial regulation because of the following reasons. I think there among most university independent economists, there seems to be now a consensus around the following points. Number one, the efficient market hypothesis on the financial market that we are having tend towards equilibrium all the time, that we have a total transparent, efficient, and cost-efficient market, that every player knows everything, that this theory is simply not true. The financial markets always present a distorted picture of reality. Joseph Stiglitz called it in his thesis he got the Nobel Prize for, the asymmetric information picture. I think that's pretty sharp to the reality in the financial market. So instead of moving to equilibrium, the financial markets move to create bubbles all the time, as they de facto have been doing, more or less since we deregulated our national financial markets. The two last bubbles we had before this super bubble we are just in now was the 2001 dot-com crisis, and the one just before that was the LTCM crisis, the big hedge fund crisis in US, which you will recall was close to bringing the financial system to a collapse also. So we are confronted with a system which are not tending to equilibrium, which having structured inbuilt mechanisms which create bubbles. And that's why my first point is that society, i.e. financial authorities and legislators, must accept responsibility to avoid and prevent further new bubbles. I mean, in the old days, these financial bubbles was only to be borne by the actors on the financial markets. But nowadays, the cost for a big financial global bubble, well, look around and think of the consequences I just mentioned to you. I was among those who got some information on the models the Lehman Brothers used before they cracked down. And I was, as many others, quite astonished on what I saw. The Lehman Brothers algorithms and mathematical models they used on the financial market was quite astonishing. They de facto, if you broke it down, built their buying and selling and expectations on a normal distribution probability curve. In many senses, the tails on the two normal probability curve was more or less of the same time, of the same size. Then you could move it by some mathematical tricks, but more or less at the essence, the construction of the probability was normal distribution, which shocked me quite a lot. And the second point was, when we then asked some of the players in Lehman Brothers, now, how did you relate to the herd behavior? And they answered, well, we was a part of it. Yes, I know you were, but did you foresee that it couldn't just go on for eternity, that it's clear that for instance, the housing market in US, which went up by 20 to 25% per year, that this could not continue because the distance between the real economy and the housing prices was simply exploding at a certain. Did you foresee that? And the answer was, no, we didn't foresee that. Because when the party is on, we have to dance in that party. And the consequences was, when you go into the model, that Lehman Brothers did foresee a breakdown of maximum 20% of this housing market. But they did not foresee a breakdown of 85% on that market, you see. So fundamentally speaking, you can say that you're not only having a market which is tending to bubbles by well-known structures, you also have in the algorithms and in the buying and selling mechanisms, whether you are acting like hedge funds or banker or whatever, you have an inbuilt structure which also lead to cracks. Which of course then mean that to avoid a